Hello and welcome to the April economic update from RCLCO. My name is Scott Bommarito, and I'm the Vice President of Research at RCLCO Fund Advisors. This month has been very notable in terms of economic developments. And we saw at the beginning of the month, President Trump announce his increased tariff policies across the board. That announcement on April 2nd has since been revised several times, and we've seen effectively a period of heightened economic policy uncertainty as we wait to see where exactly the dust will settle from all of this tariff policy. Markets have been responding with elevated volatility over the past month. And as this index on the left-hand chart shows, overall, the economic policy uncertainty has risen to the second highest level on record with this particular index, just behind the peak of the pandemic, which was the highest recorded uncertainty level. So high amount of uncertainty, high amount of volatility going on in the markets right now, which has been complicating the economic outlook for 2025 and beyond. In other news, the University of Michigan Consumer Sentiment Survey declined fairly precipitously over the last couple of months. The preliminary April reading fell to its second lowest level on record, down to 50.8. And inflation concerns were one of the main contributing factors to that decline. As we've already said, the economic effects of the tariff policies remain highly uncertain. However, there is a fair amount of economic consensus around the fact that these tariffs will have heightened inflationary pressure, at least in the near term. So that is expected to then damage consumer spending and potentially lead to a broader based economic slowdown. And that's what's getting picked up here in the consumer sentiment report, the consumer sentiment survey. So against this backdrop of uncertainty and volatility, all forecasts should really be taken fairly lightly at this point as we wait to see how the policy dust will settle, and then we can start assessing what implications are likely to be. That said, forecasts for the 10-year US Treasury yield generally expect the yield to stay north of 4%, likely in that band from 4 to 4.5% over the next several years. Looking at inflation on the right-hand chart, again, one of the more well-established effects of the tariff policies will be at least a short-term increase in inflationary pressures. Oxford Economics is calling for all items CPI to break 4% later at the end of 2025, before then moderating in 2026, 2027, and beyond. So again, in the short term, elevated inflationary pressures and the potential for a broader economic slowdown, with the medium and longer term effects remaining highly uncertain at this point. Turning to the job market, 2025 is expected to be somewhat more normal, slightly below average in terms of annual employment growth at this 1.4 million rate. However, as consumer spending starts to decline and the economy slows, we expect to see job growth moderate meaningfully in 2026. That'll be the short-term dip before then recovering toward closer to long-term averages in the out years. Looking at the unemployment rate, again, Oxford Economics forecasts that to increase to about 4.8% in late 2025, early 2026, before then moderating again. But as with all of these forecasts, a high degree of uncertainty remains around the path of any of these economic metrics. That concludes our macroeconomic update for April. Stay tuned as we continue to track volatile real estate markets and broader economy.